Hi guys, welcome to FinLadder, and today we will be discussing about technical analysis. So let's get started. Let's first understand the definition of technical analysis. So the definition of technical analysis states that it involves making trading decisions based on past prices. So first of all, we'll be using our past prices that are studied using various charts and graphs and indicators. So let's take an example. We have prices of a company. Yesterday it was for 2 rupees, then it was for 3 rupees, and then it was for 4 rupees. Now these prices are suggesting something, that the price of this company is going up. Now if we use these prices, we can say that tomorrow this company will be worth for 5 rupees. This is just a simple trend. It might go till 1 or it might go till 6, but looking at the trend, it looks like tomorrow it should be for 5. Now that is all we mean by technical analysis. Then moving on, the technical analysis does not aim at valuing security. So we are not valuing security. The most important thing over here is, I told you that there was a company which was valuing on first day for 2, then for 3, and then for 4 next day, but I never told you what that company was worth for. Maybe that company would have been worth 7 rupees, or maybe that company would have been worth for 1 rupee. We're not involved, we're not looking for the valuation of that company, but we're interested in what will happen with this price tomorrow. What will be this price next day? Maybe it would be 6, maybe it would be 7, maybe it would be 1, maybe it would be 5. But looking at this general trend, the trend that we have over here, 2, 3, and then 4, it is most certainly looks like it would be 5 tomorrow. So that is what we learn in technical analysis. Then it goes on to say that it is done to earn short term profits based on the price movement and volume traded. So the most important thing in this is, we are not involved in valuing this company. We are not saying that this company is good company or a bad company. We are saying that this company is going through a good phase or a bad phase. Now the most important thing here is going. By going, we mean that tomorrow maybe it would be up. If you're speculating that it would be up, so maybe it would be up, and that means that it is going to be up. But we're not saying that it is either a good company or a bad company. What we're saying is that it is going to go up tomorrow. So what we are concerned with is tomorrow, or a very short duration, a small duration. We are not concerned about the health of the company. We are not concerned about how good the company would do 10 years down the line. But what we are concerned with is the price movement. What will happen, in which direction this company is going for. So that is what we mean by technical analysis. Now the most important thing in technical analysis is that there are two assumptions in the market. Two assumptions. These assumptions are the pillars of technical analysis. The first assumption states that market market discounts everything. When we talk about market discounts everything, the most important thing we understand is, when we go to the market, we see, let's take an example of company Reliance. When we see the share of Reliance, and how when we see its graph, it would ideally be something like this. When we talk about years, when the time period is years, we would see in the later half it has been increasing. The reason for this is because Reliance is doing well. Now let's take an example of other company, Yes Bank. When we see its graph, it went like this, and since past 1.5 year it has been going down. In fact, it has gone down to very low levels. Now what do we mean by this fall? When we talk about technical analysis, the most important thing is that market is itself valuing a company. We say one thing in technical analysis, that we do not care about the valuation of a company, but one of the most important things is that the market itself is looking at the valuation. Because Reliance is doing well, its charts will show that. So that is what we mean by market discounts everything. So by this we simply mean that market would the prices that will be prevailing in the market would be because of some reason. If the company is doing well, its prices will come back to its original prices, what they should be worth. If the company is doing bad, even if it is going up right now, later on it will come down. That is the fundamental rule of market. Every news in the market gets discounted for. The second most important assumption is that a market moves in trends. When we say that market moves in trends, we mean to say that, let's suppose there is a good news for Reliance. Let's suppose Reliance right now is trading for 100 and it has a good news, and after 1 year it trades for 120. Now there are two scenarios how Reliance could go to 120. Let's suppose this is year 1 and this is year 2. It was for 100 and then it went to 120. So like this it could have gone like this, or the other way, year 1, year 2, 100, 120. It could have gone something like this. Now the answer to this is always this: market never goes in a straight pattern. If it has to go up, it will go like this. If it has to go down, it will go like this. But market would never go directly from one price to another. It always moves in trends. Now let's try to understand this in the real market. Here we have a price of Reliance. On this date, it's 2018-05-29. Reliance is trading for 925. Then we see it goes up. Here it comes down. Then it goes up, a bit down, up, down, and then finally here. So let's take an example. From here, we will be looking till here. The market did not go directly from 923 till 1408. How it went was, first it went up, then it came down, then it again went up, then it again came down, then it again went up, then a bit down, again went up, down, and then finally reached here. So this is how market moves. Market does not directly go from one place to another, but market moves in trends. If we have to see it again, if we have to see the trend, so here was an uptrend, then there was a downtrend, then there was an uptrend again, then a downtrend, uptrend, downtrend. So if I'll be making this, completing this, an uptrend, and then a downtrend, finally moving towards our final price. So see, it first went up and down. If we look further into it, if we zoom it a bit, if we zoom this area, we'll see that there have been more trends. Look at this. We did not see that while it was going up, there was a small downtrend as well in this. And then there was another uptrend in this. Then when it started to go down, first it went like this. Then there was a small uptrend. So this is what our second assumption states. Now let's get back and understand the third assumption. The third assumption states that history repeats itself. So when we say that history repeats itself, we mean that the prices tend to behave in a similar pattern. Now, using this, one of the most important things comes forward, which is called a resistance and support. Now, understanding resistance and support. Now, when we see a chart, we usually see that if this is our share price, we generally see some places where the market is not able to break one point. This point is called our resistance point. When we say resistance, we mean to say that this is a price market does not think this company is worth more than this price. So this acts as a resistance. So let's suppose the Reliance right now is trading for 100, which is somewhere here, and someone tells people that 130 is the maximum price Reliance should go to. It should not go beyond this. So once Reliance touches this 130, people will start thinking that Reliance is now overpriced. They would start selling it, and this would make the prices go down. Again, the prices will try to attempt to breach this 130. People will start again to think that Reliance is not worth 130, and it will again start to go down. Third time again, it tried to breach 130, but it was not able to breach 130. Now when we see say this means that there is something at this price. People start thinking that 130 is a price which Reliance should not break. Similarly, there will be a lower price as well. Even though in this example we do not see a lower price, but there will be a lower price. So let's just, for the sake of example, make our chart like this and like this, and let's call it 80. The market tried to break 80, but people started thinking that Reliance is worth way more than 80, started buying again, here again, started buying again, and again started buying again. So by this we simply mean that there are channels in which it would trade. People would have a resistance and a support. This adds up to 50, so it is trading in the range of 50. But let's suppose now there is an information about Reliance that it is going to merge with this Saudi Aramco company, and now it breaks this price of 130. Now, coming back to our example, let's say this was the range it was trading in. This Now I'm saying that it breaks this range. Now in such a scenario, let me use another pen for breaking the range. Now it here has broken the range. This 130 will act as a support now. Now people will start thinking that if Reliance was able to break this 130, it is ideally worth more than 130, and 130 would be a price which is definitely worth Reliance. So it would, let's suppose, go till another example of 150, and this will be our new resistance. When it has to come down, it should ideally not break 130, and it again starts to trade in this pattern until there is an information or any such happening where this again breaks this. If it breaks from here, it will become the support, and the next thing will be the resistance. But if it breaks from here, if it goes down, this 130 would again start to become its resistance. So again, resistance is the price it is not able to breach, and support is the price that helps it, pushes it back up. The resistance becomes a support when it is broken. This is a very important thing in technical analysis. We have to understand this. Our resistance becomes support when it is broken. So our previous example, this was our resistance at 130. Now we will break it. Once it is broken, it will now act as a support. Seeing this on, let's try to see this on a graph. So I've drawn this for you. So when we look at it here, I guess, yeah. So when we look at it here, 463 seems like a price which is difficult to be broken. So once the prices come from 3 404, goes up, goes up, goes up, hits 461, comes down. Then again it tries to breach this price, goes up, takes around 3 weeks, again hits 460, comes down. Then it again tries to go up, but this time it was able to go till 450 only, again comes down. Then the third time it goes up and breaks this price. Now it has broken this price. Let's see what happens in the future. Now here we see this price, this resistance has now started to act as if it is a support. So it went up till 480, came down, and 460 acted as a support. Then went up again till 560, had to come down and took here its support. So there is a resistance and a support. Our previous support becomes our resistance again, and then when we go in future, it might have acted again in a similar manner. Here our resistance again became the support. So this is how market works. This is how technical analysis works. This is the concept of support and a resistance. Now we talked about technical analysis, but there are a few limitations to technical analysis as well. Now, coming to its first limitation, we said that there might be an uptrend for a thing in a month, but in the same month there would be a downtrend in a week, and in the same week there might even be an uptrend for the day. So this gives us a confusing result whether to buy this thing or to sell this thing. Now, ideally, if I'm looking it from the perspective of months, I would be buying this thing. But if I was looking it from the perspective of a week, I would be selling this thing. And if I was looking it from the perspective of a day, I would be again buying this thing. So, what we mean by this is that the same thing is being bought and the same thing is being sold because of different time frames. So, this acts as a limitation of technical analysis. The second limitation of technical analysis is, let's suppose we here see that the prices are like this, then went like this, and here. Now, here, if we see that the prices have breached, we are at this position. If this is our 100 somewhere here our support was at 80, 130. Now the prices are at 140. We know one thing, that the prices will go up, then try to come back at 130 and then again go up. But it isn't only us, everyone in the market knows this. So this information of technical analysis is available to everyone. Thus, the period in which you could make this profit from where it goes from 140 to 180, everyone would be looking for this. So it is difficult, not only difficult, everyone knows about this. So you do not have an alpha. Alpha means a different thing, a thing that is different from others. So ideally, technical analysis is used to make your own trading strategies, but most of the trading strategies that are common to everyone would be used by everyone. So these are a few limitations of technical analysis we need to keep in mind before entering technical analysis. That was all from us. Thank you.